Okay, now we're live online. Hey, everyone online. Where's the camera? Oh, there's the camera. We moved it. It used to be up there. So for all you guys who don't know, right, we are Quest Trust Company. Thanks so much for coming out. We're going to go ahead and do something a little different than we typically have done because we're bringing in a very unique speaker tonight. And I'm going to talk about him in just a moment. But outside of that, if you guys are online, we have a moderator that's going to be there to ask any questions and answer any questions for you guys. In addition, make sure if you're online, you're pitching your own investments and stuff on there so people can kind of try to network in that aspect. If you'd like the speakers or any of our vendors' information, please just let our moderators know and they'll go ahead and get you that information right away. Now, I'm going to go ahead and start with some of our vendors that are going to come up here in just a moment. But I do appreciate you guys coming on in and coming on out. I know there's been a spike in COVID a little bit lately here in Houston. So we always see when there's a big spike. If you guys were here for our was anyone here for our grand opening? A couple of people. All right, I love it. So at our grand opening, we had about, I'd say 200 to 300 people here, which was really nice. And we want to get back to that. So if you're out there and you're listening there online, when we're hosting these events in person, please come in, join us. It's the best way you can network. It's the best way that you can get your information out there. And it's honestly one of the best ways to go ahead and get started as an investor. It really, really is. So without any further ado, I'm going to bring up actually one of our very first vendors. This is, I got to meet them for the first time at an event all the way out in the North Houston area. So can I get someone from Real Property Management come up? Give her a round of applause. Come on. So I'm going to pass the mic to you. Tell me a little bit about your company and what you guys can do for people.
All right. So my name's Joni Wolfswinkle. I'm the broker owner of a property management company called Real Property Management Preferred here in Houston. We manage just about 1,600 doors, and I also am a co-owner of a company called Texas Turnkey Properties. So we actually build new construction duplexes and single-family homes built to rent, and then our management company manages for the investor. So full service. If you own a rental property, we will also manage that, so don't worry. And we have a booth out there, so if you have any questions on property management or turnkey product, just let me know.
Tell me a little about your book.
My book, it's actually the first book I wrote. It's actually my entrepreneurial journey. I started at 19, so it's out there as well if you want to take a look at it. It's called The Choice is Yours, Balancing Success as a Wife, Mom, and Entrepreneur.
So just so don't go anywhere. So if we do have any people out there owning rental properties, all right, I want you to understand that if you ever try to manage that property yourself, that is such a pain in the butt. Has everyone ever tried that? Couple of people? Yikes. So definitely leverage your guys' services. In addition, you had turnkey properties as well available. Yes. So describe a little bit about turnkeys.
So turnkey, so basically what that is, so we build new construction from the ground up. Most of our product is duplexes. And we actually, once the construction is completed, we actually place the tenant in there, and then the investor purchases the property. So you're actually making money on day one. So, and the property management company doesn't go, it's all in our office, so we're doing it all.
Excellent. So, thank you so much. Yeah. Make sure you guys reach out and give her a round of applause. So our next vendor we're going to bring up here has actually personally helped me in two different areas. From not only providing me 4 different loans on 4 different occasions, okay? All right, from refinancing, all right, to actually getting a loan to pick up my own investment properties, but they have also helped me if I had money just sitting that you can place it and purchase notes from them. So can I get Gabe from Blink Lending? Come on up. Woohoo! He's wearing tennis shoes and a suit. Love it. Gabe, you got to use the mic. We got people online.
All right. Hi, everyone. My name is Gabe Lukish. I'm with Blink Lending. How's everyone tonight? All right. Blink Lending is a 3-year-old boutique mortgage company, right? So traditional mortgages, VA, USDA, conventional, FHA, we do all those loans. Where we're different is that we also do private money lending. You have a house that won't appreciate or won't appraise, come in, won't appraise, come in, we'll help you get that financing done, also help you get the rehab budget in place and move forward with it, and that creates a real estate note. And we then sell that real estate note to private lenders. Anybody interested in passive income? Right on. We sell those notes, we keep a little bit just to keep the lights on, turn everything else over to to the passive investor. It's pretty cut and dry.
So one of the best things actually I've enjoyed about using and working with them is actually the responsiveness. So you can call them, email them, even text them, and they will go ahead and get a hold of you and help you out and walk you through the process. So Gabe, what's your contact info?
It is my contact information is 1-800-BLINK lending, or mine is 713-545-8757 specifically. But also the name Blink, right? We respond just as quick, right? Thank you guys.
Thanks, Gabe. Woo. So I saved our best vendor for last, and I'm sorry. The main reason why is the next gentleman I'm going to go. Steve, come on up here, man. So Steve Vihel here and Susan, both, they run the Wealth Club. Who here has attended one of the Wealth Club events? Nice, thank you. Everyone. So Steve here literally has helped. How many investors do you think, honestly, just get started in real estate in general?
A bunch.
Use the mic.
I have no idea. A lot.
So, Steve, tell me a little bit about the Wealth Club, what you can do, how you've helped people, etc.
Well, the Wealth Club, actually, we are starting our 19th year. The Wealth Club is starting our 19th year right now, and we're just very, very honored to be running the Wealth Club. We took over. We're starting our 5th year in January, and we're about teaching education. We're for real people. I'm not a guru. I don't ever pretend to be. We teach it like it is. We want to teach you, we teach all the things we do because there's no secrets out there. Most people think they're secrets, or they, just wait, we'll get to the next thing, and that's all silliness. So we're going to teach you exactly what we do, and we have a lot of benefits for that for our membership. With a deal support line, we do a monthly mastermind with our platinum members. I do a monthly coaching call with platinum members, and so many other benefits that are out there. And the reason I think we can do this and give very good advice is because we're full-time real estate investors. This is what we do. We flip properties. We flipped hundreds of homes. We have a rental portfolio. We do owner finance. We do mortgage notes. We do some lending. And we've got some new projects that we're working on right now that once we get those going, we'll announce those hopefully in the next couple months. But that's what we do. We're here to help. Our tagline has always been investors helping investors, and we take that to heart. And we want to help anybody we can in any way that we can.
So he's not lying when he says he takes that to heart. So what's very unique is I get to work with RIAs and real estate investment groups all across the U.S. All right, I literally, in 2 weeks, I'm traveling to Georgia. In 3 weeks, I'm traveling to California to work with other groups. The Wealth Club is the only one I've seen out there where you show up, you can ask questions, you can work with real estate investors, and it's like, oh, if you want to keep working me, it costs $1 million. No, that is not this. All right. And so if you guys have a chance, Steve, when's your next event that you're going to be hosting?
Our next event is the 27th, where all our meetings, we have a live meeting. It's always the last Thursday of the month. We meet right here at Quest. Our meeting is in the Quest building. We've got a fantastic speaker coming this month. We've got Scott Horn coming. Nice. Oh yeah, Scott's this guy. Tough. Oh, he's been investor for 30 years. He's an attorney. He's does owner finance. He does all kinds of stuff. I was reading his bio today. He has purchased, rehabbed, and financed 7,000 deals. He's got experience. and Texas laws have just changed for owner finance. And he's going to come and his first part of his presentation, he's going to explain the new laws that we have to be careful of for owner finance going into this new year. So it's going to be a great meeting. I'm really looking forward to it because I'm going to get a lot of education from it. So.
Well, thank you, Steve. So how do people get a hold of you?
You can get a hold of us. You can go to thewealthclub.org. Put the in, or it's going to take you to someplace in the UK. I'm serious. It goes thewealthclub.org. If you have any questions, you can call us at the office at 713-644-3500, and we're happy to answer any questions. And come out and join us at our meeting, and we'd love to have everybody there.
Awesome. Thanks, Steve.
Thank you.
All right, guys, so I'm going to talk a little bit about Quest real fast before we dive right into our main headline speaker that's going to be coming up here in a minute. And boy, do you guys have a treat today, all right? However, right, we always like to talk about a quick disclaimer, right, where here at Quest, if my thingy worked. Bloop. We can never give you any type of legal advice. We can't give you investment advice, right? We can't go, oh, this is the best way to structure a deal. My job and our job here is to provide you the best education possible. Now, one of the best platforms to do that is always going to end up being any of the events we can host. And we try to host these events as consistently as possible to where when we are hosting them, they are completely free, right? None of you guys had to pay anything to come in. We gave you some free snacks, some free beer. You can't beat that, you know? However, we have one event each year that we're bringing on back, and that's the Quest Expo. Who was at the Quest Expo in 2019? So, Steve, I'm sorry, man. I know you're just up here. Roughly, how many people do you think were at the Quest Expo? 800 people at the most recent expo. Now, we are hoping to double that number. Do you guys know why? Because we're at the tail end of it, and people are excited. They're excited to come out and check these events out. So if you do want to attend, this is going to be one of the few events that we actually have to charge for, but tickets are cheap, right? If you get and you visit us online, right, we can get you the tickets for about $150 a pop. So you can't beat that. Ben, you're looking at me weird. Is it? Yeah. Oh, nope. Good. I got the number right. Woohoo! So, without any further ado, I do want to talk a little bit before I bring up our next speaker about why we asked them to come in. And you can go back in our history and you'll notice that we've never actually had them come into our classroom and give this type of presentation. Now, Quest, we started actually all the way back in 2001. And when we did, shortly after, we met a young and up-and-coming company by the name of ZT Wealth. Has anyone heard of ZT Wealth? So ZT Wealth, what they really did is they went forth, they found and they built a lot of really healthcare style facilities. And they did nothing but give back to the community. And on top of giving back to the community, they were giving back to their employees. And the model that they designed to build their entire company fit the model of Quest because we were almost hand in hand. We really were. Both companies were growing at the same time simultaneously. And nowadays, they have somewhere right upwards around 1,500 employees. That's impressive. It really, really is. In addition, they have raised capital in so many different areas from something called ZT Baseball, right, where they literally are building baseball stadiums and have baseball programs for underprivileged kids to get started in this. They have what they call the Outlets Foundation, which helps develop a cancer organization to provide cancer treatments for individuals that need treatment that can't always afford it. If you ever have a chance to go to one of their galas or one of their raising capital events, you got to see it. It is unbelievable because they have given more back to the community than almost everyone else in this room probably combined. All right, so we really wanted to bring them in here to really stress and talk to you guys about why you should be investing in certain different areas, sometimes outside of real estate. All right, things from investing into healthcare aspects, things from investing into motor industries and other areas like that. So we really went forth and wanted to bring in the senior vice president, Azhar. Azhar from ZT, can you please come on up? And everyone give him a humongous round of applause. Bam. Are you mic'd up? Do you have this on you? Do you want one of these on you? This is good. This is good? I'm going to pass the mic to you, man. It's all you.
Perfect. Thank you so much, Derek. Thank you so much, guys, for having me here today. Wow, I did not expect a full house. People are standing, and this is fantastic. Thank you, guys. Thank you, Quest. So, for this presentation, this is not really a presentation. This is more of, I know it's supposed to be an educational class, so this is going to be very interactive. Feel free to ask me any questions while I'm going through my slides, because I want to make sure that I am able to answer any questions right away, because I know personally, me personally being ADHD, I have a question, and then all of a sudden, I completely forget about it. So I don't want, I know a lot of people are like that, and if you have a question, just feel free to ask me right away, and I'll help answer it. By a show of hands, can I see who are investors today that, are here for investment? And then also a show of hands of who is interested in building their own private equity fund or want to, want to raise capital on their own. So first I'll go ahead and who wants to raise their own capital fund, want to learn how to raise money and things like that? Good. And in terms of investors, who is here as an investor that's interested in investing in private equity investments? Pretty good. I'm going to do this, guys, because our streamers will think this is a huge arena. So perfect. So, okay, good. So it's balanced. It's 50-50. So I can help answer all those questions. So before I begin, a little bit about me. I have been in private equity for 15 years. I'm a partner at ZT Corporate. I know Derek had mentioned 1,500 employees. We actually have over 4,000 now. We are in the healthcare and the automotive space. I personally have done more than $400 million worth of money raising. I have exited a lot of our businesses that we've done as well for more than $350 million. So, when it comes to private equity, feel free to ask me any questions of how to structure it, how to raise money, how to exit, who to sell it to, how to sell it, how to buy into a deal, how to buy into businesses. Good thing is I have some experience in the real estate market as well. But today's talk, I wanted to diversify it a little bit away from real estate because a lot of people do real estate. It's very easy to find. But when it comes to businesses and things like that, there's a whole new world out there of investing into businesses where you're buying into cash flows, where you're able to get dividends from it, you're able to pay out your investors right away, and I could help you guys structure those deals as well. And for the investors out here, it'll give you guys a kind of different kind of investments that you guys see, because I know everywhere you look around, as an investor, and I'm one of them, I see real estate everywhere. Oh, what do you do? I'm in real estate. Oh, what kind of real estate? Oh, I'm in apartments. Okay, good. Hey, what do you do? Hey, I'm in real estate. Okay, what do you do? Apartments. Okay, good. Hey, what do you do? It's like everyone you talk to, it's apartments, it's storage facilities, it is single family homes, which is great. I'm invested a lot in them too, but this is a way to kind of diversify away from that too, as an option. Options are always good. Just, these are some of our portfolios. We have automotive dealerships. We have about 12 brands in across 3 states. We're about to go into our 4th state in Dayton, Ohio. So. Why not Tesla, my friend? We would, because a good question. So you had said, for the streamers, he had said, why not Tesla? The reason we don't go into Tesla is we feel that other companies that we're invested in, like Chevy and Toyota, they will be the market leader of electric vehicles. And they have a huge fleet coming through for the electric vehicles. Tesla is a very, very, very small speck in the market of auto dealerships. So I hope that answers your question. Yeah. So what is private equity? You see movies and you see CNBC and they're mentioning private equity, but you're probably thinking, ooh, private equity, I need, $50 million to invest, or it's a big boys game and things like that. Private equity is quite simple, actually. Private equity is just an investment that doesn't have a quote on the stock market, and that's it. It could be a pen. If I sell this pen to everyone, and I raise 10 cents from each investor here, and you guys can own this pen, this is a private equity investment. As simple as that. The houses and things like that, a lot of flippers here. When you guys raise capital for your housing project, that is a private equity investment. You could call yourself, hey, I have a private equity firm. I have a single family house. You can do that. So it's quite simple. But there's a reason why people have really hyped it up, because they want to keep the normal person out. They don't want everyone to be in this industry. They've kept it exclusive, and they've tagged it as exclusive. But it's really not that exclusive if you look at it. Yes, there are laws and rules and things like that that protect it when you're raising a lot bigger money. And if you guys are raising or about to raise a lot more money, if you have any questions, I could help answer that today as well. So misconceptions about private equity. You hear, when you talk to people that, hey, I invest in private equity, they're like, oh, You do? Is it oil? Did you lose your money? Is it gold? Is it gold mines? Things like that. So people think of it as high risk, but private equity can be far from the truth. It's a lot more controlled risk. I wouldn't say there's no risk or low risk, but it's a lot more transparent. If you're about to invest into something that is private, it's easier to get hold of their financials. It's easier to go visit that business. It's easier to go visit that real estate to see what they're doing, what their business operations are. So I would say it's more transparent. Plus, you're not paying very, very high multiples either. So let me go over the multiples a little bit. When you buy a business on the stock market, let's say you're buying a $50 stock. If the company is profitable, there is what's called a multiple on their earnings. So let's say for a Walmart stock, they may be making, for example, $1 billion, but at you're buying it at a $40 billion valuation because it's 40 times its earnings. That's what's a multiple. At the public market, usually you're paying what the pub market is willing to pay for it, which is the most optimal market value. When it comes to private, the multipliers are a lot more cheaper. So let's say you have a business that's making $1 million, and I, as a buyer, is wanting to buy it, and the market is willing to pay $6 million for it. That's a 6 times multiple on your business. On the stock market, you will not find that. You will not find a company that's selling at a 6 multiplier that's a stable business. The stable business, you could expect to pay anywhere between 15 to 20 times the multiplier. So when it comes to private businesses, you get a lot more opportunities. And the deals are a lot more sizable. They can go up as the size goes up, but if you're as a private investor, you guys do have options as well to invest in it. Another misconception is it's only available for institutions or the ultra rich. Not necessarily. With technology today, there are a lot of companies that people can start off with as low as $1,000. So there's a lot of options out there to start investing in private equity as well. And I'm going to go over that today. Guys, before I move forward, any questions so far?
Yes.
Go ahead.
You might get to this, but I'm thinking of it now. So, you said that you were in automotive,
Yes.
right? You've had a huge supply chain issues.
hmm Actually, let me give you the mic. How about that? So just for our streamers out there as well so they can hear the question.
Okay. So, good afternoon, everybody. My name is Terry Azus with eXp Realty. And so my first question is, you said that you were investing in automotive. And so I'm wondering, with the supply chain difficulties we've experienced here recently, how has that affected your profit and loss statements? And then the next question is, you're also in healthcare. And I think maybe you said you were in homes, like nursing homes. And so I'm wondering, with COVID, how has that affected you as well?
Can I have your name again?
Terry Azus.
Terry uses, well, very good question. So I'll address your first question first. So supply chain issues in the automotive industry, and how has it affected the bottom line? That's probably your question, right? It is great. It is fantastic. We are able to sell cars way above the MSRP, which really affects the bottom line in a very good way. Now, from a consumer standpoint, it's not very good. Do I think, as being a person in the industry, that's going to last forever? No. Is it going to be a short-term pinch? No. It's probably going to be a 18-month pinch at the moment. And it's not only about the supply chain, it's also a lot of companies are having a harder time getting labor as well. That's another issue. Also, a lot of the companies have labor strikes that's going on. So that affects the supply chain and a lot of labor. But at the end of the day, has it been more profitable? Yes. Every automotive company right now is making record profits. And when I say automotive company, I mean dealerships in general. They are able to turn out a record profit. And I'll add to that, when it comes to a dealership, we all think of new cars, right? But a dealership actually makes money about 11 different ways. It makes money from new cars. It makes money from used cars. Also, a lot of used cars, they actually auction these off as well, that are not sold to the consumer, but sold to other dealerships. They make money off of that too. They make money off of extended warranties. They make money off of financing. They make money off your tire warranty. They make money on parts and service. Parts in general, there's about 70% markup. So the key that you lose, and you go in at $600, there's a huge markup at that. Yep, I know you're laughing. It's true. Yes, you probably lost your key. Yes. There is, service. And now companies have gotten so good on service that they time their employees. The time it goes up for oil change, by the time it comes down, it has to hit certain, by the second, it has to hit that number for that employee to get bonuses. It's very, very efficient. Very efficient. So it's been the supply chain issues and things like that have been good for the industry as business owners and as investors. The consumers, unfortunately, is suffering. But I think about 18 months from now, I think it'll be better. Now, your second question was on the healthcare end, how is it affected? And also if we are in the nursing home business and things like that. So we are not in the nursing home business. We're in the hospital space and also in the emergency room space. We are the largest private emergency room business in Texas. We own brands such as Neighbors ER. I'm sure you guys have heard of Neighbors ER. We have brands such as Austin Emergency Centers, and also we have brands such as Altus Emergency Rooms as well. So because of COVID, there's been a huge surge of patients that are coming in, so that has helped the business. In turn, it's helped us as a company. It's in turn helped our investors as well. And the best thing is it's helped our patients as well. Because we're a private facility, our patients are able to come in a lot easier with minimal lines. You know, when you go get a COVID test, everywhere the prices are the same. But a lot of people, they go to like these free centers with tents outside and things like that to get testing. But you can walk into your emergency room and a lot of them have PCR testing and rapid PCR testing and also antigen testing as well. And you won't have to be in a big line either. Because you're an emergent patient, we have to take you. So even if you're not an investor and you go home today and you're like, I learned about COVID testing, that's good. So if you've learned about that, I've done my job as well. Thank you. Perfect.
Do you have allegiance with Aetna and the other
Insurance carriers? So Streamers, his question was, do we have an allegiance with a lot of the major insurance carriers like Aetna and United and Blue Cross Blue Shield? Yes, we do. Yeah, we were contracted with all these insurance companies. Perfect, go ahead.
I have a question about private equity in general relative to people that are used to being in publicly traded companies. What is the main difference as far as liquidity? Like if you have to get out of the market and then, regulation too, so you may have more information, but how regulated is it and audited financials and those sorts of things compared to the stock market investment?
Very nice. What's your name? Troy. So Troy has a very good question in terms of liquidity. What does the liquidity look like in the private equity space? And also he's talked about the regulations. Who regulates the private equity market and how does it look like? And also in terms of financials, do they have to be audited or unaudited or fine? Is that your question, Troy? Okay. So I'll go over your first question in terms of time horizon. I have that in the presentation today. Basically, it really depends on what you're investing in. Sometimes you guys will get an investment, which is a note, and it can be a 3-month horizon, where you let someone borrow the money, and they're like, hey, it's a bridge loan, you'll turn it around in 3 months. That's a private equity investment. That's a 3-month horizon. Sometimes you're giving it to a business, and that business is telling you that, hey, I have an idea. I'm going to turn this business into a monster business. But it's going to take me 10 years. But I'll give you a 10x return. By the way, run away from those type of people. But it can happen. So the horizon is 7 to 10 years. So my technical answer is, it really depends who you invest with or what kind of fund are you setting up. But you have to let your investors know and give them an expectation of how long you could really set up this kind of investment. Like if I'm talking to my investors, if I know that it's going to take me 3 years, it's safe to tell them that it's going to be 3 to 5 years. A lot of investment companies will give you a time horizon. Because it's illiquid, you can never time the market on when you're going to sell it. And a good company always gives you a range, but they give you a good amount range. So it really depends. I hope I answered your question. Now, the last part of the question was in terms of compliance. Who are we registering to? Who are we accountable to, and things like that. That also depends. Depends on how big you are and how you register. I'll start from top to bottom. Big companies, they're usually registered with the SEC, which is Securities Exchange Commission. Also with FINRA, which is another body of kind of governing body. And when you are registering with them, there's a lot of exemptions that you could fall under. Private equity companies can fall under a lot of categories because it depends. If you're raising $1 million, are you raising 10 million? Are you raising $1 billion? Different exemptions fall under, depends on how much money you're raising. But let's say you're doing an apartment complex, because I know a lot of people here usually aggregate funds for apartment complexes and things like that. You may not have to register anywhere, because you know what? The way the SEC or FINRA is looking at you is you're probably going to friends and family, unless you're marketing it like on Facebook through like some ads and things like that, hey, I'm here raising money, $5,000 a pop, $5,000 a pop. Then you have to register. You cannot be doing that. They can come down on you hard because there's certain regulations you have to follow. And I'll go over that a little bit in the presentation as well. Perfect. Any questions before I move on, guys? Oh, go ahead, Hector.
If you're investing with your self-directed IRA account, with the new regulations that are going through, I'm not sure if it's going to be effective to invest in a private property, in a private equity, sorry.
Very nice question. So Hector asked a question that if you're investing it through your Roth IRA, or just IRA in general, just your IRA in general with the new changes coming, will it affect your private investments and things like that? So the answer is yes. All the same regulations that will happen to general IRA should be falling under for private investments. But to help better answer that, Derek, if you're here or you're around, if I've answered that incorrectly, do let me know. But the laws for private equities fall under the same category as any investments for IRA. Hope that answers your question. Yeah. Go ahead.
If we were investors interested in investing in private equity, what kind of criteria would we look for in comparing different funds?
Perfect. So what's your name again? Jason. So Jason had a question that if you're looking to invest in private equity, what kind of criteria would you look for? So that's a very good question, yes. The certain things that you would look for is, number one, who is bringing you the deal? That's number one. You want to make sure it's a legitimate person that's bringing you the deal, or a legitimate website, or a legitimate resource that's bringing you that deal. Another thing is, look at things from the merit of the deal itself. That's very important, of what they're giving you. I've gotten people solicit to me saying like, hey, I'm going to give you this and this and this and this. One thing I ask is, sure, send me your agreement, send me your subscription agreement or your offer. Let me see what you have to offer. Also, another criteria I look at is, how's my money secured? It can be unsecured, but I want to see that if you go belly up, what kind of chain of command I will be in, and if there's any value that I'll recover beside you. Because every time you need to make an investment, you have to look beyond the person as well. beyond the owner, beyond the CEO. You have to look at it from an asset perspective that, hey, if this goes into liquidation tomorrow, how much can this business recover from its individual merits? I'll give you guys an example. Let's say you guys, I'm starting a shoes company, okay? And I already, it's not a startup, and I already do $1 million in business, and I've used all my money to do so. Now, I come up to you and say, hey, I know this business can do 100 million. I make $1 million right now, but I will be making 100 million. For this, I'm gonna give you an opportunity to invest, and you could put $100,000 in my company for a 0.5% share. And for that, you will get equity in the deal. But right now, I'm not making 100 million. So you invest in my deal. You say, yes, Azhar, you look like a trustworthy person. You wear a gray suit at night. I'll trust you. You invest in it, and let's say I go belly up. Now, all the promises and things like that I made doesn't come through. Chances are you will not be able to recover your money. So in this situation, you should see that, okay, if this person that's asking the money, is it for future earnings that they're promising? Or is it for growth capital? Is it they're wanting to get out? Like as me as an individual, am I trying to sell my shares to liquidate myself a little bit more to kind of become a little bit liquid? Because that can happen. A lot of businessmen who own 100% of the business, they may want to sell 50% of their business, 60% of their business because they don't have liquidity. They've made money for over the years, but they're putting it back in their business. But they may want some liquidity for themselves. So that can happen as well. So in the example I gave you was for growth capital, my shoe company. But all the promises I gave, I didn't come through. So chances are you invested on the future valuation of my company, and I didn't come through on that. And I went belly up, and you've lost your money. But let's say I did make $100 million in this business, and suddenly I pass away. Now you're looking around saying, uh-oh, Azhar's passed away, but his company is doing well. We need to liquidate. All the investors get together and say, we need to liquidate this business. Chances are you will recover your money and a lot more. So always look at the deal on the merit of the deal. Also, see what your rights are as an investor. Typically on a private equity investment, there's usually a general partner and a limited partner relationship. General partner are the people that usually put the deal together. They take on the risk, they take on the loan, things like that. Limited partners are just partners in the deal from a financial end, but not necessarily on a operating end. General partners are the one that usually operate it. There are chances in certain deals that limited partners may be asked to be signed on to the loan. It's not a bad thing. It can be asked, but that means the risk goes higher. That means that potentially there may be a lot more return. But if someone's asking you to sign on some loan documents with you, you have to just make sure that is your return worth it for you to be vested in this deal with this individual. I hope I answered your question. Yeah. So why should you invest in private equity? Number one thing I would say is to diversify. And a lot of people here are invested in private equity, which is good. It is, you're diversifying your portfolio through your real estate you may have or some businesses that you may have apart from your stock portfolio, 401k portfolio, and things like that. Another reason is you get an opportunity to invest directly into a business. I'm sure many times it's happened where a cousin nephew or a cousin or uncle comes up with a brilliant idea and says, hey, I'm going to be, expanding my business and I'm looking for capital. I'm going to my family members to do so. That's a good way to get into a business with a direct relationship and directly into the business that you could see, touch, feel, and you know the gentleman or you know the lady that's doing the deal. So it gives you direct access to a lot of deals, and it opens up your portfolio for a lot more investments. Because when you go to the market, you are going to pay the market rate. Even if it's cheaper, that's still the market. That's what the market is willing to pay. But in a lot of private equity deals, a lot of people raising money, sometimes they're desperate. They really give a lot away to raise capital because raising capital can be really tough. It's easy to put a deal together, but to raise capital, oh, I have to do that? That's tough. That is very, very tough. Also, in terms of returns, people invest in private equity because the returns can be higher. And in some instances, a lot higher. A lot higher. Any questions before I move forward? Go ahead.
Are those returns in form of dividends or in selling your share, or what? How do they happen? Yeah.
So Jose asked, are those returns in form of dividends or selling your shares, or how do you make these returns? So it really depends on the investment. Typically, if it's a profitable business, as a limited partner, you are getting part of those profits through distributions. Because if it's a limited partnership and that business does not give you a dividend, you still will be taxed on a phantom level. So a business would not want to do that to its investors unless that's the deal that the promoter or the person that's running the deal has told you up front that, hey, we will be profitable, but we will be reinvesting these dollars into the business to where you may have to pay taxes on them, because reinvesting dollars in a business does not mean you're getting a tax break. But you may be taxed on it, but it's going to be used for future profits. So one way of making money from these private deals is dividends or distributions, but also when you exit. Now, there are many, many ways of exiting in the private equity space. It's not only selling straight up your business. There is what's called a dividend recap, where if the business is making dividends on a consistent basis and it's a big enough business, you could go to a bigger company, on all they do is for future dividends, they will hand you guys a huge loan to where that can be paid off to the investors. But the deal is the investor may not get dividends for the next 5 years, but they'll get an upfront payment. So it's kind of like an exit without really giving up your shares, or you may have to give up a small amount of shares.
It's like selling a note.
It's not like selling a note. So I'll give you an example. This Quest IRA building, for example, okay? Let's say it makes $1 million a year, and you're, as an investor, you own 10% of it, and you're making $100,000 a year on this building. But in the next 5 years, you'll make $500,000 from this building. So a company comes along and says, I like this building. I think it's going to be worth a lot more in the future. What I'll do is I want to be part of that growth. I know the dividends for you will be $500,000 for the next 5 years. I will pay you that $500,000 now. I will buy a little bit of your shares and still be an owner, and you be an owner as well. So for the next 5 years, you may not get dividends, but you've gotten an upfront payment that you could reinvest somewhere else. Plus, you're along for the ride for this building. Now, the company, why should they do that? They may have bigger plans. They may they may do a dividend recap for this building, but they may expand this building, and they may be the owners of it. So they have a lot more rights. It really depends on the kind of rights they get as a business. But sometimes, depends on the deal, you can participate in the upside or what the deal was. It really depends. But that is another way of exiting as well. Or this business will get sold, and you may get $800,000 because you were getting, $100,000 a year in income. Any questions? I hope I answered your question correctly, Jose. Go ahead. Here, you want a mic?
Claudia Russo with eXp Realty. Quick question for a rookie here, rookie realtor, rookie investor. Going back to your question about raising capital, I know there's a lot of experience in the room, but for the people streaming like myself, how do you commence raising capital? What's your top tip for rookie people I've got a lot of deals in my sphere, in my conversation. What's the best top tips for a rookie to start, like, leaning into, starting that conversation?
So Claudia, if I understand your question correctly, what are some tips to raising capital? Correct? And how do you get started and things like that? How do you really go about it? There are many ways to go about it, but it really depends on what you're willing to do. There's a traditional method of door knocking, and it's true. You just have to go to places where there is money. There's a lot of money out there, and believe it or not, people are wanting to invest. People are itching to invest. People who have money are always looking for deals. So it's up to you, Claudia, that if you're wanting to raise money, you have to be where people have the money and just talk to them. You just say, hey, I have a proposal for you. I'm doing this single family property. It's $60,000 right now. But when I rehab it, it'll be $140,000. I'm raising for $60,000 to buy the deal and also $40,000 to rehab it. But I promise you that the $40,000 extra that we make, I'll split it with you, $20,000 each. In a deal like that, you won't need a lot of fancy things like a subscription agreement, a PPM, and things like that. You don't need any of that. You need a simple agreement that, hey, we're doing this deal together. If you get hit by a bus, there'll be a lien on the property. The investor will be able to sell the property, or whenever it gets sold, they have a lien against it, so their money is protected. Very simple. An attorney can do that for $600 at a closing or $500. Very common. So when it comes to money raising tips, guys, go where the money is at. A lot of people are looking for opportunities, and if you're able to give people an above market return for what they're already getting, they'll be interested. So any specifics you want to know or how you want to go about it, you can do it through Facebook. As long as you're doing it through your friends and family vicinity, a lot of there's not going to be, the government's not really going to come after you for trying to raise 100,000, 200,000, $1 million, $2 million, things like that. But when you get to the bigger money, then yes, you have to go through the proper channels and things like that. There's attorneys that can help draft up agreements for that. You're welcome. Go ahead.
Thank you. I'm Steve Dancer. We own a real estate brokerage, also a consulting firm, and an investing firm as well. Not on your level, but we're aspiring to get there, right? Where does the consummate deal maker come in on this? Let's say I'm not the investor, I'm not the business owner, but I'm really good at putting two parties together to make deals happen. Tell me how I can do that with you guys, because that's an element of our business, primarily on luxury homes, but we're looking to expand into businesses as well, and we're dabbling in that. But it appears to me there's a place for someone like us to fit into your space, or at least somewhere near your space. How about that?
So very good question. So this is, deal makers, people that put people together, affiliate marketers, call it whatever you want. People who put two people together, is there a space for that in bigger businesses? There absolutely is. There's no difference in you finding a $100,000 deal than a $1 billion deal. There's no difference. Big companies, small companies, individuals are always looking for good deals who have money. And if you're able to get them that, you will get paid a fee, a handsome fee to do so. So regardless of the industry, regardless of what you're doing, regardless of the deal size, if you're a matchmaker for a business, for real estate, or any company, you will get paid handsomely. And there is a need for that. Go ahead.
And that really helps answer my question. Are there cases that you've come across yourself where the deal maker wants to stay into the deal and become a part of the passive income on a deal as well? Because that's our play on the deals that we work on.
So the question is, can the matchmaker become a equity partner and get the stream of income or get some of the part of the profits that may be made in the future? There absolutely can be. It really depends how you negotiate your contract with them and the kind of deal that you have with the promoters that you're willing to do this deal. But also, it really depends on the negotiations you guys have up front. there definitely is always space, and they can be both. But also, always remember, a lot of big businesses, if you're going to stay on, they may ask for what value do you provide on the ongoing basis, because guess what? When investors come into the deal, they question things. And they're going to be like, why are you here? We're putting in 10 million bucks. You haven't put in any money. What value do you bring on an ongoing basis? Because as an investor, they're very short-term thinkers. Even though they invest long-term, they're also short-term thinkers that, hey, I wanted 1% ownership, but why do you have 1% ownership without really providing a lot of ongoing value? So, it can happen, but there's questions that you should be able to answer and continue to see that if you want that ownership, how can you continue add on value for that business? But it can definitely happen. Thank you. Perfect. So levels of private equity investments, you could start off as little as $1,000. You could just Google saying private equity investments for beginners. And there's a bunch of companies that you could go in, and they'll give you a list of businesses that you guys can invest, and it can be as little as $1,000. And it's not only equity that you could buy in. They may be promissory notes that you could be a part of. It could be a preferred company where you invest in it, and before the management, investors get paid first. Also, there'll be a lot of time horizons and things like that, anticipated time horizons that'll be written on there. Certain individuals they come in at a minimum of 100,000, 50,000, and they're accredited investors. And you want to go through a proper private equity firm for the retail market. I have written some examples down here. Feel free to contact them as well. The reason I put them down is a lot of them I've known and I've invested with them. So as an individual that is accredited, that does invest at a minimum of 100, 200, 250,000, 500,000, they're good examples to invest through. But with them, what you'll get is a lot more bigger deals, the $10 million deals, $20 million deals, $50 million deals, and also a lot of creative deals. It'll be apart from just real estate, hotels, storage facilities, and things like that. It'll actually be businesses that they'll be doing as well. So that's a key point, because any way you look at it, I don't care what anyone says, real estate is really not a business. It's an investment. It's hard to get very, very high returns on a consistent basis on it. But on a business, you do one thing creative, your 10% return goes 300% return. Can happen. When you sell real estate, you may make 2 times, 3 times, 4 times, 5 times your money. Businesses, sky's the limit. I've personally seen people make $80 out of $1. I've seen companies go public, private equity company, they can go public. That's an exit strategy. They can go public, and their 100,000 turns into a couple $1 million. Go ahead.
My name is Christopher Bui, and I was curious if you guys have any capital partners like such as acquisition partners that buy any oil rigs out in I think towards the Delaware Basin or somewhere towards like Wood County.
Very good question. Do you guys have partners that buy oil rigs in certain basins like Delaware Basin or some other county? Traditionally, we've stayed away from oil rigs. It is not our business model, but our investors. I've personally seen about 15 deals that I've seen my investors invest in it. You know how many have succeeded? Take a wild guess. Out of 15. 0 is a pretty good answer. You guys are pretty close. It's 1. 1 oil well, actually, or oil rig has done well. It's great as a tax kind of benefit. Sometimes the only people that make money is the promoters or the person that's raising capital for these deals. Not to say they're not bad deals, but they're not the most realistic deals. They're a little bit more speculative. And if you're looking for a short-term tax break and want to take a chance, I would invest in like 20 of them at once. I would not just give money to just one company. And guess what? A lot of companies will say, we will only take a minimum of 100,000. Bullshit. Just give them 10,000, they'll take it. Yeah. So, perfect. Now, the bigger money, there's also family offices as well that invest. Family offices are businesses, are families that have made money over the years, and now they've aggregated 50 million, 100 million, 150 million, all the way to a couple of billion. Now, it's actually a hassle to invest in your $200,000 deal. It's a hassle for them because they're not checking their mail, you know. Even the people that they pay to go check the mail, it's more expensive for them. So they're doing deals that are 5 million at a minimum at a time. So for that, they go to companies that are able to handle those kind of volumes. Okay, I'm not going to go too much into that. I don't know if a lot of people here are interested in family offices and how to set them up, how to get investments from these guys and things like that. But I'll just say that a lot of these companies that are family offices, if you want to raise money from them, it's not that hard. It's just as easy as raising capital from individuals. Just make sure that you're showing the raise amount that's big enough for their appetite. I hope that makes sense. It's worthwhile for them. They're not looking for a $10,000 check a month, I promise you. They're looking for $50,000 to $100,000 check a month, you know, on a consistent basis, or a bigger return that's really worth their due diligence time. They will do due diligence, but it's still worth it. Another tip, a major tip I'll give fundraisers, Claudia, I'll give you, don't run after people that are going to invest a small amount of money. They will be the most headaches for you because you want to go to people that actually are investors and understand the game. Because from my experience, the people that have invested the lowest amount of money, those are the people that call me the most. I tell you that. So that's just a tip that, hey, there are just as many people that will give you a bigger check, even if you're first time raising capital. They know the game. They know how to protect themselves. Usually when you're closing a deal, they will have their own attorneys review the deal. And pretty much all the deals look pretty much the same. So don't be afraid to go to the people that have money. Perfect. Go ahead.
We use apartments as an example, and some of those deals, my understanding is that people can be cash called. Is that common in the private equity investment? It seems like the car dealership you're talking about. When I buy the private equity, am I also expected to contribute additional funds at some point possibly?
Very good question. So he's talking about cash calls. What is a cash call? You know what? The business has raised $1 million and now they've run out of it. And they need more money to keep the business afloat. So guess what they'll do? They'll call their partners that have invested with them that, hey, we've kind of ran out of money. We need you to pay up a little bit more because you're a partner in this deal. If not, this deal is going belly up. And usually these calls are like, we're a week out from, you know, dissolvency and things like that. This happens. So how do you prevent yourself? That is very normal, even in the private equity space, in terms of not normal for companies to do so, but in agreements, it keeps it open because you are a partner. And that's how you got to look at it, that, hey, when you're investing, even as a general partner or a limited partner, you're a partner in the deal. And you take part in the upside, and also you take part in the downside. Something you have to accept in anybody, even if you're raising money from individuals, that risk is there for you. And the first people the promoter will call is his current partners and say, I need to raise more money. And you have to do it. If not, you'll lose your principal. They'll always say that. How do you protect yourself? Usually when you're raising money, there are certain clauses in there that you can omit. You can never really say there'll never be a cash call because you are a partner. So at the end of the day, you have to be willing to participate, that if there is a issue with the business that you will have to put money in. If not, you give the right for the promoter to go raise the capital somewhere else and dilute your shares. That can happen as well. They always can find new investors to dilute your shares as well. That can happen, but typically in a investment, current investors get the first right of refusal. Did I help answer the question? Okay. How often does it happen? Depends. It really doesn't happen that often. If you've really studied the deal, if you're going to do the deal the right way, if you look at the numbers as an investor, and if you see that, okay, they're making money already, what is the margin of safety there? You have to look at it just the way you would look at stocks. You know, if things go bad, what'll happen? Can they liquidate before they come to me? That's how I look at deals. But there is a possibility that if you're looking like a oil well and oil reserves and things like that, I see cash calls all the time. All the time. Even after the cash call, they go belly up. So, you know, it can happen, but not necessarily. I'm just kind of beating down on them because I have horror stories on oil reserves and things like that. But typically on like rental properties and apartment complexes and things like that, I don't see a lot of cash calls. It can when a lot of these companies they reserve some money, but then they dividend out a lot of the money. So they can come up with a temporary situation where there's cash tightness. That can happen. And that's when they will do a cash call. But typically they have some reserves. And you want to make sure when you're giving your money to a investment company to see what do the reserves look like. What are the backups reserves? So ways of investing, typical investments, it's not only just equity investment. Someone's raising capital and they say, hey, you can get 1% share of my company for 100,000. That's typical. But also, there's also a preferred ownership, just like how you have preferred stocks. They're going to the restroom. Don't look at them. No. Thanks, guys. You know, there's preferred, like, meaning like if you're going to raise capital from someone, you could say that, hey, as a promoter, I will only make money after you've made a 12% return on your money for that year, and anything above that, we will split it. And that split, it can be 50-50 or whatever that number is. And I'll give you guys an example. Let's say you guys make $1 million deal, and you are promising that investor that, hey, you will make the first 8% before me, the person that raised money from you, will make anything from that deal. I will make sure you'll make 8% first, and then after that, we will split it 50-50. Okay? So let's say it's $1 million deal. The dividends are about 100,000. That's 10% return. So for the first 8%, it'll go back to the investor. The last 20,000 that's left over, I will keep 10 and the investor keeps 10. So that's like a preferred return type deal. It can happen with 6%, it can happen with 8%, it can happen with 12%. Really depends on the business. A lot of real estate deals typically are 6 to 8%, and then after that, they split it with the promoter. In businesses, the margins are higher. You're able to make a lot more money, a lot more of a higher dividend. The promote will be maybe 10% or 12% before the split starts. Really depends. Depends on the business as well. And the third way of investing and kind of way of investing is through promissory notes. How you guys give promissory notes for real estate? I'm sure a lot of you guys, by show of hands, who has let others borrow money on their real estate deals? You guys have, right? Exactly. Same thing can happen for businesses as well. People think that it's a lot more risky because real estate, you can go out. If someone doesn't pay you, you guys can sell it. Same rules apply for a business. It can be a secured note. It can be an unsecured note. All you have to look for is, hey, if this business doesn't make, if not, it's not able to pay its obligations, you have the right for that business, and the promissory note holders can push the business if they default to liquidate. The best thing is, in a business, you get paid first before the equity holders. So the same rules apply what would apply at real estate level as well. So the returns would be similar as well. Okay. Yes, you can do that as well. Ben, is there any questions from online that I've missed? Or? Mm-hmm. Very good question. So you will get opportunities from out of the country. In this situation, it was someone approached them for fruits and what? Fruits and produce from Belize. My answer to that is depends. Is it a random email? Is it a Nigerian king asking for money and they have a deal? Happens. Huh? Your Gmail account? Exactly. Really depends. Usually, if it's somewhere out of the country, their laws are different. I have seen investors invest in gold mines in like different countries. Then none of them have made money. I have friends who have a lot of Belize properties and things like that. They do okay, but it's always a hassle being in America to try to go look at your properties or look at your businesses or do a deal from America to that country. Unless the deal is big enough and you are like a family office style business that you're able to do the right kind of agreements, you can afford a lot more local due diligence and things like that. Because in the private equity space, due diligence is a thing. Individuals, you guys will do due diligence, companies will do diligence. And the best thing is there are third-party companies that can do due diligence for you as well. Believe it or not, the bigger the company, the more money can buy in terms of due diligence and also quality of earnings and things like that. A lot of small businesses say that, hey, I make 500,000, buy my business for 3 million. If you're buying a business for 3 million, you're not going to go out and spend hundreds of thousands of dollars to do a quality of earnings on them to see that do they really make 500,000. You're just going to go in their business, sit in for a week and see if they really do that or not. But for big businesses, not only do you do that, you sit in their business, but also you have third parties sit in that business to really see that they do make the money that they say they do. And then there'll be third party auditing company and you have audited financials and things like that that you go through. Okay. I think one of the investment processes that people should look at is, and this is a very good model to look out for, is people ask me, what's the best kind of private equity investment that a person can make? I say buying into a company that is making money, but they're also acquiring similar businesses that are the same business in different areas. And the reason I say that is your margin of risk is a lot lower because they're already making money. You could see the profits. But when you buy similar businesses, what happens is you're raising the total value of your enterprise automatically. I'll give you an example. If you have a business, if you have one business, let's say it's a gas station, okay? It's a gas pump. You're selling that business. You will sell, and you make $1 million. You will sell this business for $3 million. That's pretty much the going rate of any small business. You make a certain amount, you times it by 3, and that's your selling price. A broker will tell you, it's very common, 3, 3.5, 4 times. But let's say you have 10 gas stations, and they all make $1 million each. Same, rather than selling one, you have 10 of them, and they all make the same amount of money, $1 million each. Now, you're not paying $30 million for that business when you go sell it. When you go sell it, you're not fetching $30 million. Now you're fetching $80 million. It jumps to 8 times because you're selling at a package. When you're selling these many gas stations, you get cheaper gas. You could sell a lot more things from your gas stations that are extra, like lotto and things like that you could add on. A lot of big businesses, it's not even worth it for them to do due diligence on one gas station, but they'll buy 10 gas stations because it's a lot easier, more efficient, they're willing to overpay. But let's say you have 100 gas stations. You're not selling it for even 800 million. You're probably selling it for 2 billion. Bigger the company, the bigger the valuations that you'll get. So you want to be invested in a business that's already making money, and their game plan is to go buy similar businesses like the one you're investing in. That is the best kind, because guess what? They don't have to do anything. They don't have to turn around the business. They can keep the business the way it is, but they're adding on similar businesses automatically overnight. Your enterprise value is increasing. That's how you turn your couple $100,000 into a couple $1 million in doing a investment process like this. A lot of times when you're investing as an investor, I'm talking about, what I see is when you invest in a business and you're increasing your businesses, a lot of times big companies, they add on more professional staff. So a lot of small businesses, they only have a bookkeeper. They will bring on someone like a CPA. They will bring on a CFO. These things matter when you're building a big business. So if they're going to be growing their business, a lot of these things come with it. That's how it's called professionalizing the business. Now you have options to exit the business. Go ahead.
You said earlier something about taxes. And so my first question is, exactly how does this affect my taxes? Because that's very important to me at this age. And then the next question is, what is your fee structure?
So very good question in terms of taxes and fee structure. The way depends, your taxes really depend on the kind of business you invest in. Real estate, you could do a lot of write-offs and things like that because someone's living there, someone's paying your rent, there's depreciation and things like that. So a lot of your taxes are pushed forward towards by the time you sell it, by the time you recapture it. In a business, you're not necessarily getting the same benefits, but typically you're getting a higher return. So there's a give and take. So you're paying the taxes up front, unless you're investing it through a retirement account, 401k IRA, self-directed IRA, Roth IRA, things like that. So there are benefits of investing and getting a tax benefit, but it has to be through a retirement account, or a lot of people invest through trusts. There are ways to really, big businesses find ways to mitigate their taxes, and a lot of wealthy people do as well. The bigger you get, the more wealthier you get. There are ways to mitigate your taxes, but as individuals like us, you will be taxed at a ordinary income. So let's say that you're in the highest tax bracket and you're getting dividends. Let's say you're in the highest tax bracket and you get 100,000 dividend from this individual business. You will be taxed at your individual rate. Compared to a person who is in the lowest bracket and have invested, they'll get returns at the lowest bracket. It really depends. So it's considered ordinary income when there's dividends. So in terms of fees, it really depends. A lot of private equity companies do two types of fees. There is management fees, where as they're operating the business. Good thing is, in a business, there's enough cash flow to where the private equity firm can take a management fee out to actually manage the business. And then also, when you sell the business, there's some sort of a profit sharing split that goes to them. Would you like to know how much usually? So it really depends. A lot of private equity firms, what they have is what's called carried interest, which means that they have sweat equity in the deal. So let's say, you're raising $100 million. That doesn't mean that if you invest $1 million, you're a 1% partner. The private equity firm may take 20% of it, 25% of it. So you may be like a 0.75% partner for the $1 million that you put in.
So ZT Corporate, what is your management fee?
So it really depends on the business. It really depends on the revenue of each business and the kind of margins you have. Small margin businesses, you really can't take a high management fee compared to the revenues that you have. So it's never really tied to the revenues. It really it ties in the market of what if someone else is running the deal, how much would they be charging for that business? So that's how it's comparable. So let's say we're running a dealership out in Georgia. The business makes $100 million in revenue. That doesn't mean that's our profit. Our profit may be $4 million. Out of that, we may take $400,000 in management fees, for example, and the rest goes to the partners. But a lot of private equity companies, they co-sign they actually sign on the loan for these deals. A lot of limited partners wouldn't. It's too big of a loan for individuals to sign. Regardless of how wealthy you are, big deals, banks don't like to have multiple people signing on these loans. So they want individuals not being involved in the loan process. So they want one company or one CEO to sign it. So for that, they get shares for that as well. And they may have invested equity in those deals as well. So it really depends. But whatever the fees are, usually they're all market. They're very comparable, in terms of any other company you go for. If they're running this deal as a management company, that's how much they would charge.
So are you saying basically you guys only have two types of fees in your company?
Yeah, management fee, it's not really a fee. We're managing the business. So it's like salaries, consulting, there's legal fees and things like that. So management fee is just you running the business and then whatever invested capital that we have. The biggest incentive usually that a private equity firm gets, including ZT Corporate, is when you sell the deal. Every time you sell the deal, you get part of the fees, part of the ownership. So a lot of our deals are 25% ZT Corporate and 75% investors. So when we sell a deal that sells for 100 million, ZT Corporate makes 25 million. So, but that's our incentive to sell the deal, which makes money for the investors, therefore makes money for ZT Corporate. Any questions? No. Ways to invest, 3 ways to invest, as your own personal name, through a company name, or a retirement account, self-directed IRA plans. Very simple. An entity can be a trust, can be a limited partnership, can be a LLC, can be a sole proprietorship. You name it. It really depends on how big you are, the kind of tax mitigation that you're looking for, and also personal protection that you're looking for as well. Any questions, guys? Yeah, go ahead.
How does the pandemic affect your business? I know you're very diversified.
Mm-hmm.
Certain business types are better than the others.
Very good question. So how does the pandemic affect a business like ours? We're only in 2 businesses. We're in healthcare and we're in automotive dealerships. Both of them are doing well because of the pandemic. But regardless of the pandemic, these businesses are very stable. They tend to do well regardless. People are always going to get sick. People are always going to go to the ER. And rather than going to the big hospital ERs where you have to wait 5-6 hours, you go to a smaller ER that takes you in within 15 minutes. So an ER business tends to do well regardless, and including the dealership business as well. If you're not buying cars, you're still servicing your cars. If you're not servicing your cars, you're leasing your cars. If you're not leasing your cars, you're buying used vehicles. There are just so many ways to make money in the car business. So I hope that answers your question. And also, everyone is commission-based in that dealership, anywhere you look at it. So the guy that greets you outside, the guy that values your car, the guy that does your service, the guy that does sells you the car, they're all commission-based. So if the business is low, commissions are low, but the business always stays profitable. It's a high variable expense business. It's a very low fixed cost. Yep. Any questions? Go ahead.
On the first being, if it's a partnership and you're in there as a partner, let's say not for tax purposes, but just the mechanics of how it works. If that person passes away, does it then go to a family member if that's the way it is, or does that position have to be liquidated?
Very good question. The investor that's invested and, God forbid, they pass away, what is the process of, is it liquidated? And that can happen through divorce as well. A lot of people divorce and what happens in a private investment. So my answer to that is it depends. Depends if it's usually goes to their estate, and whatever their estate reads out, the company has to follow orders. A lot of times what happens is someone passes away, the company has to automatically switch their investment into the estate of the person who passed away, and then wait till what the court has ordered or what the situation looks like at the estate level to where the shares go. Typically, there's no such thing as liquidation unless someone is willing to buy your share in the private investment market. So I hope that answers your question. Same thing as when you get divorced. People get divorced. They have to split their assets. Usually, just split the shares rather than the cash. Yes, a very good question. Voting rights for limited partners really depends on your limited partnership agreement. You could make it as flexible as you want. As an investor, when you're looking at it, there's usually your rights section that you see that, hey, do 80% of the partners have to agree? Do 50% of the partners have to agree? It's all spelled out. So when making a private equity investment, just read their limited partnership agreement. Typically, if it's a limited partnership, unless you're investing in an LLC, then there's usually operating agreements and things like that that you could read. Go ahead.
In the public space, there's a whole market how is that in the public sector? Is there a market?
Oh, you mean private sector? Yeah.
How's that in the private sector? Is there a market space, and if I need to liquidate out of a deal, how does that work?
Very good question. What's your name? Scott. Scott has a very good question that in private equity, if you need to liquidate, 7-year time horizon, that was good at a time, but I need money now. It's been 3 years and I'm in a bind. I need the money now. What can I do? Is there a place that you can go to liquidate your shares and things like that? So the answer to that is there are many ways. You can go back to the company and say, hey, I know you're doing well. Do you want to buy your stock back? A lot of companies, if they're doing well, they want to buy more of their shares back. Just how it happens at the public company, it can happen on the private level. Usually they buy it at a discount. They'll look at it as, hey, how much did you pay for those shares? $250,000? Oh, we'll buy them. We know it's worth a little bit more, but you need the money now. It's an opportunity for the company. Also, the company can say that, hey, I can buy it, or I can find you a buyer, or you have to find a buyer. That can happen as well. Sometimes the values have gone up over the years. You could try to find a buyer on a private market that, hey, I have these shares, but I have this payment that's coming up. I need liquidity now. So that can be another way. Or the company can find you a buyer. And also it'll be a negotiated rate that you negotiate. So it doesn't have to be the amount that you paid for. It could be a negotiated rate. Something more, something less. Sometimes companies are not doing well. And guess what? It's not only you wanting the money back, it's every investor wanting their money back. That can happen. And typically, investors call, say, hey, give me my money back. You guys took my money. That's how they'll talk, You took my money. It's like, hey, the business was, the money was used in the business. There's no money, and the business is not doing well. So they will say, what are my options? Well, you could try to liquidate the company and see if we can get money that way. Or we're doing our best to make sure the company is becoming profitable in the future. How about you try to find a buyer, and I'll try to find a buyer for you as well. But I always suggest that if you feel you're going to have any of those problems in the future, if you need liquidity, private equity or private investments are not your cup of tea. Do not invest in items that if you feel that you will need this money in the future for the time horizon that they're telling you that they'll divest you. Good. Sorry. Next. They can. So options can come into play. So you can get very complex with private investments. They're just like public companies. You know how, what's the Tesla's CEO? Elon Musk. He gets paid by stock options, stock bonuses, and things like that. Same thing as private companies. They can do that. They could structure it exactly like how public companies structure their deals. So options do come into play. A lot of times there's warrants that are handed out to key employees that, hey, at a certain strike price in the next 3 years, you could exercise this warrant. You will have to pay for it, but you can do that. And sometimes they're unpaid warrants as well. So private companies and public companies, they're not that different. They're just companies. And you could be as flexible as you need in a private company. It all depends what's written in your limited partnership agreement, in your bylaws, in your LLC documents, operating agreements. I mean, the list goes on and on. It's all about the agreements and how flexible you want to make your company. Hector, you had a question?
Yeah. So if you do an investment with that company, does it go into a general fund and you guys decide where to put it, or it goes, or you do it specifically for each project?
Are you asking for specifically for where I'm a partner of, or in general in private equity? Okay, very good question. So the question is, for our firm, when someone invests, does it go into a general pool of money that we decide what to do, or does it go into a specific project that is intended to go to, like, are we buying one hospital at a time, and that's how we're raising the money? So my answer to that is typically we're doing individually. We will tell you what we're about to buy and will not buy. But there are other funds out there. Sometimes it can be a blind pool fund that, hey, we need to raise the money now because 3 months from now, we may buy a deal, but we can't tell you about it because there's an NDA out. A lot of big deals, there's a lot of NDAs out, there's a lot of brand names that, they're public brand names. When we bought Neighbors ER there's 50 other companies that were wanting to buy Neighbors emergency rooms. So we can tell openly in the market that we're buying Neighbors ER. The company that you see while people are playing, the Rockets are playing and the Astros are playing and there's ads are going on. We can't tell the investors that, hey, we're buying this. But what you could say is, hey, we're about to make an acquisition and it looks like an ER, and it's going to be an ER, and it's possibly going to be in the Texas area. So we may say like, what were you about to do, and then raise the money. Sometimes it can just be promissory notes where, hey, the business is doing really well. Our company right now, we're not really raising money on an equity level because we are very liquid. We've sold a lot of our assets in the last 5 years. We're sitting very pretty, but we're very profitable, but we're looking for opportunities still. So rather than doing equities, we just do promissory notes where a person invests and they're getting a fixed % return over the years, and it's short term. It's typically 2 years. So they invest, they get their interest on a monthly basis like clockwork, never missed a payment, never defaulted or any of that. And then in 2 years, they get their principal back. So you give up your upside of any profit, but you're getting a very high % interest rate like clockwork. So because we're a mature company and the stage we're at, we're doing promissory notes only. But as a company, we are, the reason we're in 2 industries, we used to be in 3 industries. We used to be in Popeye's chicken. We eat those, right? So we used to have about 19 Popeyes. We sold those. We operated for about 3 years. Investors made about 60%, 12% on dividends, and then like 30% or something on the exit. We used to have banks. We made good money for the investors, more than 15% a year type situation. And then we had a infusion business. Infusion is like infusion therapy. And that made about 9 times the return for the investors within 5 years. So it really depends on the business. We have sold more than 8 businesses, like big business brands, but tons of individual businesses as well. Go ahead, Ben. Yes. So currently we're raising money for promissory notes. So that gets paid on a monthly basis. Go ahead.
So the SEC regulates the public space. Is there a governing body that regulates the private space?
So the governing body that regulates the private space is typically SEC and also FINRA. But yes, there is regulation. If you're very, very small, they may not look into you. But when you start getting a little bit bigger, you fall under the SEC or the FINRA. And they do audit you as well. They come in randomly and they'll pull out files and say, oh, let me see Mr. John today. They'll go over the files to make sure everything was done correctly. Sometimes they'll call Mr. John and say, hey, you've invested with these guys. You say that you're accredited, you make this much money. Do you really? They may do that. So, the more the mature the company, the more audits and things like that you get. Good?
Question on accredited. When we get our investors for our project, we always ask for accredited. But what kind of proof do you need to get from accredited? Because they do that.
Yes, they do that. So, Stephen has a very good question. If someone says they're accredited, how do you check that they're really an accredited investor? Now, let me back up a bit. Let me go over what is an accredited investor. An accredited investor is someone who makes, as an individual, makes more than $200,000 a year, and as a family, they make $300,000 a year or above. That's one criteria. Another criteria is if your net worth is more than $1 million, apart from your primary residence. That's very important. A lot of people are like, I'm a millionaire. I was like, okay, how much is your house worth? 800,000. How much cash you have? How much, there are a lot of people are banking on their primary property to be an accredited investor. It doesn't work that way. It has to be your primary property has to be off of this net worth for you to, and it has to be worth more than $1 million. Third way for you to be an accredited investor is you own a business that's worth more than $5 million. That's another way. Like a lot of trusts and things like that. When kids inherit a lot of trusts, and they personally may not be accredited, but their trusts may be, or their business that they've inherited may be. So how do you check? A lot of companies, really depends. A lot of companies go through a third-party accreditation company where you have to provide them documents, the last 3 years of tax returns and your personal financial statement. Or you can have your CPA sign that, hey, I've done this person's taxes for the last 3 years, and this person is an accredited investor. It's like a check mark, and they sign it with their CPA number, and then you sign it. It's quite easy. Also, a lot of private equity companies just do a self-accredited. And the reason they do self-accredited is, let's say, Jose. Let's say I get to know you, we're talking to you, you've talked to me about your properties, I've come on a drive with you, I've known you, you do have the properties, and I know you're a wealthy person. And Jose goes, I'm going to self-accredit myself because I don't want to go through my CPA. Because I have a relationship with him, he can do that. But Sally from the internet goes, I'm accredited. I want to self-accredit. You know, I saw your firm on an ad, and I promise you I'm worth $100 million. They have to go through a third-party accreditation. So that's another way. Also, depends on how you're registered as well with the with your filing. There are a lot of exemptions that a lot of companies fall under. A lot of companies that raise money through I'm getting into the nitty-gritty, but raise money through a 506C exemption, they definitely need a third-party accreditation. But a lot of companies who raise money through 506B exemption, they can get away with just their investors doing a self-accreditation that the investor says, hey, I am accredited. But there's give and takes for both exemptions. One exemption is a lot of companies that you see ads for on social media that, hey, we're raising money for an apartment complex, we're raising money for this or that. Usually those companies, they need a third-party accreditation. But there are companies that work on you on an individual basis, one-on-one. They get to know you. They know everything about you. You could do a self-accredited signature. I hope that answers your question, Stephen. Perfect. Go ahead.
As real estate investors, we go on the MLS to look for deals. So how do you, as private equity company, look for your deals?
Very good question. So as real estate investors, you guys are going through MLS to search for deals and things like that. As investors, is there like a aggregate, place where you guys can look for deals and things like that? The good news is there is. The bad news is the whole world's looking at them as well at the same time. So you have competition. There are certain companies that I've written here. You can go to their website, Cadence, CrowdStreet, NextSeed. There are a lot of deals and things like that you can look at. They're your typical deals. You're not going to get a lot of home runs and things like that from those. You can go through private equity firms, start a relationship with them, and if they're doing a lot of deals, they're not an operator. They're just, a deal junkie that they basically are giving you deals and they're someone else's deal. Usually I recommend people to work with people that are doing the deal and they're just doing 1 or 2 deals a year. And they're doing good, solid deals and they have a track record behind them, and you start building a relationship with them. If you're looking for a lot of deals to kind of float your money through or just put in a little bit at a time, the best bet is internet has a lot of aggregation of investments. And they're typically, just normal deals. You're not going to get, sometimes you can get like a home run deal, but typically you're going to get your deal that you're making 8%, 9%, 10%, 12%. I hope that answers your question, Jason.
I mean, it's like if you're looking for opportunities,
Mm-hmm.
where would you go? Do you have connections? Or is there
As an investor, you need connections, or as a business?
as a fund?
As a fund, where are we going? So as a private equity firm, where do we go for opportunities? That's what you're asking, correct, Jason? Okay. If we're a private equity firm and we're experienced in that field, you usually have your brokers and things like that that you deal with. There are a lot of companies that can find you deals, but also a lot of off-the-deal markets that you just get through going through trade shows and things like that by building relationships. It's no different like this. I saw a lot of people came in. A lot of you know each other because you guys go, and a lot of you have done tons and tons of deals, but you guys know each other because you guys have built a relationship through these type of events. So same thing in healthcare. It's a very small market. It's a small, high barrier to entry type of business. So people get to know other people with similar deal size. You know your competitors. You can go to them, work with them, things like that. And also, when you get into the mega big deals, the 100 million plus deals, there are certain brokers that specialize in that market. It's called a middle market. The sweet spot is anywhere from 100 million to about $1 billion. So there are brokers that just exclusively deal with that. So we don't use companies like that when we buy, but we certainly use them when we want to sell. So Jason, I hope that answers your question. Perfect. Yeah.
You can also look at like a company's social media page. Like I know Grant Cardone, he's constantly talking on his social
Yep.
media or YouTube about the deals that he's working on, and then he'll say, if you want to invest with us on this deal, this is where you go to.
That's correct.
Like family office, same way that you come and pitch your deals right here, you want to pitch a $50 million deal.
Yes.
There.
Yes.
Sort of the middle market brokers in Houston are Statesman Business Advisors, Gold Star, Apex, Continuum.
Yep.
There's a list of those guys that are brokering deals that are probably bigger than $1 million in EBITDA through up, then you move
Yep.
up the food range, the Houlihan's, and then there's specialties in sectors like software as a service or other businesses.
Yep.
But if you're looking for small deals for early investments, there's the Houston Angel Network, there's places
Yep.
like that. But those are not real estate deals.
Yeah.
Those are extraordinary.
Venture funds. Yeah.
25,000, 50,000, $100,000 investments you make, but you want early deals. They're just a very different portfolio of.
Absolutely. Absolutely. Go ahead. Go ahead, Hector.
On your promissory notes, what is your average interest that you pay?
So Hector had a question that on your promissory notes, what is the average interest that you pay? Depends on the risk. Currently, the risk is the businesses that we're raising money for. They're very stable businesses. They have a long year's worth of track record. So right now we're paying 12% for 2 years. Interest rate paid on a monthly basis. So approximately you could expect 1% a month, depending on if it's 30 days, 31 days, or 28 days in the month. It's prorated according to number of days, and you're making 12% a year. For the year, you're guaranteed that 12%. And it's only for 2 years. So once it matures, you get your money back, or before that. There's no prepayment penalty on our end. So when we raise the money, and if we're selling the business, we have to give the money back. We just give it back without any penalty. So let's say we paid back in 18 months, the individual has made 18%, basically. I hope that helps answer the question. So, and last thing, a very good option a lot of high net worth people have is, a lot of high net worth guys have brokerage accounts in big firms. There's certain people that I work with as well, certain firms. A lot of big accounts, rather than doing margin to buy more stock, what a lot of people do is these companies let you borrow like a line of credit and extract certain amount of money from this. So let's say that your portfolio is $50 million. You're able to extract about 30 million of it as a line of credit. You don't have to take it out right away, but it's lower than inflation rate. Basically, let me tell you that. It's a very, very small interest that you pay, and you're able to invest in a lot of deals. That's how people that take a zero salary but have a huge stock portfolio is able to invest in more income-producing investments as well. So, pro tip for you guys. Perfect, guys. Thank you so much. If there's any questions, feel free to let me know. I'm going to hang around here. Thank you. Thank you.
Thanks, man.
Thank you.
That's awesome. All right, everybody have a good night tonight. Awesome. Another hand for Azhar, please. That was amazing. So if everybody had a good time tonight, make sure that you RSVP for February 1st. We'll be right back here for our next Houston Social. The neon colored sheet here check us out on all of our events throughout January, Tuesday at noon, Saturday at noon, more great education. And thank you all very much. Have a great night. Thank you.